I recently had a customer ask me who Fannie Mae or Freddie Mac were. So I thought I'd take a minute and explain Fannie Mae and Freddie Mac's role in the mortgage industry. So Fannie Mae and Freddie Mac were established in the 1930s after the Great Depression, and their sole function was to buy mortgages from the banks so that the banks can turn around and have more money to lend the following month. Today, about 60% of all mortgages being done in the U.S. end up getting sold to Fannie Mae or Freddie Mac. Now, the customer doesn't notice this sale. It's not as if they're ever going to make a mortgage payment to Fannie Mae or Freddie Mac. That's not to be confused with the mortgage company that sells the servicing. We've probably all experienced making their mortgage payment to one mortgage company, and then the following month they're making it to another mortgage company. And that's not what we're talking about. It's a behind-the-scenes transaction so that the mortgage company then has money to lend the following month. And typically a mortgage company is going to make a gross profit of 3% of the loan amount. So on a $400,000 loan, the mortgage company might make $12,000 in profit for selling the loan to Fannie Mae or Freddie Mac. The sale of the loan only happens if the mortgage company abides by the Fannie Mae Freddie Mac seller guidelines and collects all the necessary documentation. So what happens if the loan is closed improperly and doesn't get bought by Fannie Mae or Freddie Mac? The mortgage company will typically have to sell it in a scratch and dent market for 90 cents on the dollar or worse. So in other words, if it's a $400,000 loan that was closed improperly, Fannie and Freddie reject the purchase of the mortgage. They end up having to sell it for a $40,000 loss. So I bring this up because occasionally I'll get a customer that's frustrated with the underwriter's list of conditions, and they feel that it's a personal attack on their character, that they're not going to repay the loan. The underwriter doesn't think they're going to repay the loan. And I have to remind them that that's not the case at all. The underwriter is just trying to make sure that the file fits the Fannie Freddie seller's guide, that the loan will be sold, and that the mortgage company won't have to get stuck selling the loan for a $40,000 or $50,000 loss. So that's the point I wanted to drive home in this video, is that the underwriter is not some big bad person trying to make life miserable for the customer. They're just trying to make sure that the loan gets sold and goes where it needs to, and the company makes its profit and doesn't take a huge loss.